All right, guys, another great episode of PFREI. I'm your host, Fuquan Bilal. I'm excited for this interview. Oh man, we were just talking about you were on actually episode 51. So guys, I did about 110 episodes and life got in the way. Life got busy. That's my excuse. So I kind of fell short and stopped bringing you guys the value for about maybe 7, 8 months. So we're back like we never left. And today, got a good buddy of mine, Fernando. I don't want to screw up your last name. Is I know it's Lucci,
Angelucci. Yeah, that's it. It
Angelucci. I
means
don't know
angel of
why.
light in Italian.
Angel of Light, Angelucci, Fernando
Hmm.
Angelucci. So I think I saw you last time you presented at our mastermind the time before last, and you was talking about a deal you had did. We'll jump into that, the storage deal.
Yeah,
Oh man, I kind of like following what you do because you looked at the multifamily stuff and then you made this pivot where you was like, okay, no tenants, no toilets, no trash. I don't know about no trash, but we'll get into what you're doing. But by the age of 30, Fernando has built a portfolio of 200 million in self-storage. Now a lot's changed since we talked, so we got to
that's
dig
right.
into that, right? So self-storage asset class across the country within the last 4 years. So Fernando's diversified his investment between purchasing existing cash flow and assets, built a ground up REIT grade facility. I will talk about that also because I know you did a ground up storage thing that kind of changed the game for you.
Right.
Utilizing adaptive reuse conversion of a big box retail stores into Class A self storage. In addition to his own acquisitions, Fernando provides other self storage investors access to off market facilities at drastic discounts, capital for strategic partnerships and opportunities for passive investors to participate in these self-storage syndication. So you just went like left field self-storage all the way. So before we jump into that, I know I asked you before, but for those people who may not have seen my show, the first question I always ask is, why are you passionate for real estate investing?
Man, I'll give you the same answer I did on episode 51, right? I came in, son of two immigrants. They worked their asses off, working for the man all the time. And, they're changing time for money. And that's not the way to live. If you want to become wealthy and truly have freedom in your life. We were just chatting before we started recording. I'm actually down in here, Brazil. I've been here for 2 months. I'll be here for another 4 months before I go back to the United States. It all comes from being able to make your money work for you and not trading time for money. So that's my biggest passion. I always tell people my why is I want to be able to do what I want with whomever I want, whenever I want.
That's awesome, man. And I see the glow too, man. I see the glow. I'm a little jealous of the glow, man. You glowing too much. I'm hating. No, it's good, man, because I remember seeing you like I'm a big energy guy, right? So when I meet
Yeah,
people, I can read energy. I can see if a person is like, you know, if the handshake matched the smile, right? If the
right.
energy is good and they there, or if they just like faking the funk. So I noticed the last time I saw you when you had made that transition, maybe like a few years ago, you was like, hey, I'm making a pivot. I'm doing self-storage. I don't want to deal with the tenants
Right.
and my multifamily thing. And you just laser focused on that. And then you hooked on to a really big deal. You collaborated with some other people, did a partnership, made the deal happen, and sold that. So let's
Yeah.
jump into that. And then we can go back into why did you make the pivot from the multifamily to the self-storage?
Right.
Yeah,
So, I mean, we met in Collective Genius, right? This must have
correct.
been, well, 4 years ago now, three,
Yes,
4 years ago, something like
correct.
that. So at the time, I was doing everything. I was wholesaling residential. I was doing Airbnbs, fix and flips, buy and hold small apartment buildings, doing hard money lending. And I was just getting pulled in too many directions. And then a mutual friend of ours, Gary Harper, was in my room with Sharper Solutions. He's like, dude, I presented on why I like self storage. And he's like, why are you doing anything else? Like, this is clearly your passion about this. This is what you need to spend all your time in. And for a while, I didn't believe him, right? I just like, when you get you know, hard advice, you don't want to take it right on the chin. So I kind of deflected for like 12 months. And then I realized, you know what, Gary's right. Got to shut everything down. So I shut down, very profitable wholesaling businesses, very profitable Airbnb and hard money businesses. I mean, they were making good money, but what Gary basically told me is like, man, you have the ability to make $1 billion company if you just focus on this one thing. Like Gary Keller always says, right? Focus on the one thing. So I shut it all down. And then through, the power of masterminds, we always talk about it in Think and Grow Rich, right? The power of masterminds, being able to bring you together with people that help you solve problems that they're also having. I ended up hooking up with a couple of people in that group. Scott Myers was one of them. Scott Myers is like this self-storage guru, right? He's been doing it for 20 years or something like that. And I said, hey, Scott, I've been doing these small deals, buying these mom and pop deals. And I want to do some big stuff. I want to do some stuff where my buyer is like a publicly traded company. He said, all right, let's do it. So I found a deal, brought it to Scott. Scott's like, hey, we can definitely do this. So we raised the money. We told our investors. So we built, let me back up. We built a 3-story REIT grade Class A facility. So all temperature controlled, high tech, top of the line. It was 140,000 square feet gross, and then about 108,000 net rentable square feet. So the actual square footage you could rent out about 108,000 net. We told our investors that we would build it for 12.7 million. But then when I was talking to GC, I said, listen, man, like, you really want this deal? Fine. Put your money where your mouth is. I want you to become an investor on the deal. You got to put your own money, not the company money, not you exchanging some fees. I want you to literally wire me money from your own bank account to be an investor in this deal. And then so all of a sudden, he's an LP. The GC is now an LP. And then I tell my investor, okay, we're going to build it for 12.7 million, but then we'll sell it in 5 years for about 18 million once it's stabilized at about 90%. That it was like 966 units. This thing is like a monstrosity. So what actually happened was, so that would have turned out to be like an 18.6% internal rate of return to our investors. What actually happened was our build cost went from 12.7 million down to 10.5, because now we got the builders on our side, right? So now he's looking at the bottom line, not the top line, because now he's being incentivized correctly. He's a good buddy of mine. His name's Jeff Maritini. His company is fantastic. So if you guys are looking to build storage, hit up Maritini Construction. And then instead of it being 5 years to sell it for 18 million, we got a buyer out of San Francisco, Trojan Storage. They came over and they made us an offer at certificate of occupancy, which means the second the building is done being built, you get a certificate of occupancy from the municipality. It allows you to start renting. It allows you to bring public into the building, right? It's safe for the public to walk in. So SEO, they gave us $18 million. And that was a 13-month project instead of 5 years. So instead of making 18.6% internal rate of return, my investors made like 112.6. They got a 2.33 times equity multiple on their money in 13 months. And then that just like blew it all up for me. Everybody, no one wanted to take their money. Everyone reinvested immediately. And then from there, we just kept doing bigger and bigger things and faster. And now I closed on a deal this morning. So now we're at about 250 million in storage in the last like 4-ish years. I bought my first facility in August of 2018. So a little over 4 years now.
That's awesome, man. That's amazing. And a funny story about Scott, actually at the last mastermind event, it was chicken with peppers and rice, right? So we stand in the line and he goes, hey man, you should try that. So I'm like, oh yeah, I like chicken peppers. So I go to the table, eating my food. And it's not a red or green pepper, it's like a different color, like a yellow or something. And I eat it and I'm like, oh my God, this thing is crazy hot. So he's just sitting there laughing. I'm like, why did you do this to me? Scott's funny.
He's a good guy.
Yeah.
He's a really good guy. He was my original mentor in self-storage. I went through his boot camp in like 2016 or something like that. He's awesome, dude.
Yeah, man. So I just going back to what you said, like when we first met, you had a lot of different irons in the fire, and I didn't see that glow. Yeah. It was like everybody else that's trying to figure it out and thinking, okay, let me do a little bit of wholesale, let me do a little bit of this, and all of that together is going to get me where I'm going, instead of focusing on the one thing, putting all your energy and effort into that, and then having that success, that optimized daily experience, sustainable over time. So I see it now, and basically, so you're saying this is it, self-storage all the way. No holding back. Now let's talk about some of the, I mean, that's a good story, right? There's bad that come with it too. Let's talk. I was actually funny. I went to get a U-Haul truck the other day, and a place where I got a little 10-foot, I was moving some stuff from my garage, and the lady at the self-storage place, she was talking about, giving the lady her keys, checking her in. So I'm just sitting there scoping it out, like, this is cool, seeing how I operate, right?
Uh-huh.
So she goes, "Hey, don't leave your lock open because she had to sign a waiver that they can periodically do inspections,
Uh-huh.
and the lock is open." I overheard her saying, "Hey, because some people sleep in these containers," and I'm going. So I was like, when the lady left, I said, "Ma'am, do people actually live in these containers?" She's like, "You only know the stories." Like people actually, I don't know if you experienced that, but people actually rent the containers and live in there, and then you got to evict them out. So I'm like, so this thing does have tenants. I don't get it. I don't get it. Did you heard any of those stories?
Let me tell you about a deal I bought a couple years back in Hampton, Tennessee. So number one, let me just clarify: you don't need to evict them if they are living in your tenants. They don't get squatter rights, right? I'm just going to tell you right now. It's a trespassing. It's not an eviction. So one of the things why before when you saw me now I'm all glowed up. Before I was all stressed out because I had to deal with that shit, right? I mean, I owned rental properties on the south side of Chicago. Like it was tough. It was tough to be a landlord out there. Englewood, Marquette Park, it was difficult. So I bought this facility in Hampton, Tennessee. It's this tiny little town in the mountains of Tennessee. There's maybe like 5,000, 6,000 people in the town. We made an error, which is against our rules. Typically, the second we buy a place, we fire all the employees and then put our own employees in, right? But this one, we were in the middle of a couple of different closings. We didn't have time to go hire new people. And then when we did like a precursory reaching out to people in the community who wanted to manage the facilities, was a little tough because everybody was on like Social Security, disability income and stuff. So they all wanted us to pay them in cash. We can't do that because of the policies of our company. So it's tough. So you know what? Let's just leave the manager in place. So I buy this place, and then I'm like, on Facebook and Instagram and Snapchat, telling my friends like, look, I bought some. I think this is like facility number 6 for us or something at 7. So I was like super pumped, like really excited. And then all of a sudden, my friend asked me the same question you did. He's like, "Hey man, you ever find out somebody live in your facility or something?" I came across this crazy article, and he sends me this article, and it's like man and baby living in self-storage self-storage facility. The baby was less than 1 year old. I'm like, that's crazy. So like I'm reading through the article, and I scroll down, and then holy shit. I get to the bottom article, it says Hampton Self-Storage. It was my facility. I bought 3 days earlier. So I find out it was the manager's like baby daddy. They weren't married, but it was like her baby daddy, but it wasn't her baby. And she's like, he needed a place to stay. And I was like, you think this is a place that's conducive to have a child?
Wow.
So this created one of our immediate policies. So the reason he was able to do this is because every one of the units had a light bulb. And that light bulb people can unscrew and then hot wire electricity into their unit. So then he had a mini fridge, he had like a lazy boy in there, a TV, all running off of this like light bulb switch that he was using. It was crazy. So, we told the manager, like, you can't do this. You got to tell him he's got to leave. And then we said, hey, if he's not gone, we understand there's like personal connection here, but if he's not gone within a couple of days, like the police will show up and they're going to escort him out. So they finally left. And now every time we buy a facility, we tear out all the electrical conduit in every one of the units.
So there's no power in the unit. How do they see?
No, this is one of those facilities that was a Class C mom and pop facility. So it's what's called fortress style. There's all the units make a perimeter around the site, and then you have some buildings on the inside. So you have these spotlights, like Walmart parking lot or something, that are in the facility,
Yeah.
lights up the
Yeah.
grounds, and it's enough to see inside the facility. And then
Makes
typically with
sense.
us, we don't want anybody at the facility after dark anyway, because that's how trouble starts happening. So we don't allow that. Now in our Class A facilities, it's high tech, extremely controlled access, right? So just to get into the building, you have a keypad
Yeah. The
code.
fob to get in.
And
Yeah.
yeah, and that code is only identical to you. So I can watch you walking through the facility because you got to go through multiple checkpoints and enter your keypad. And then the lights are motion. Again, no lights inside the units, no electrical inside the units, but all the lights are motion sensors. So you walk there, it stays on for like 10 minutes. And then if you don't move or whatever, it goes to sleep. Or if you leave, it goes to sleep. So we don't have those issues in the Class A deals, which is the majority of what I'm doing now. I just sold off a majority of my Class C facilities in June of 2022. We sold a large portfolio off at a 6.2 cap rate. It was a good deal. We tripled our money in 3 years. It was
Wow,
good,
that's
good
awesome,
portfolio.
man. That's awesome. Are you finding it now in this climate where we are with interest rates and everything else, investors running for cover, not sure what's happening? Are you finding it harder or more challenging to raise capital for deals in the current climate?
So yes and no. So raising capital is actually easier. Like equity is raising easier for me, and I'll touch on that in a second. But the debt is a lot harder. You know, when I first started in this business, I was getting debt at 4.5%, maybe 5%, depending on how risky the deal was. If it was existing cash flow versus ground up development. And then on Thursday, I was just quoted. Oh, no, I'm sorry. On Monday, I was quoted 7.67% on a cash flowing deal. And then we
Holy
had that
crap.
75 basis point raise. So I'm assuming now my debt's going to be at 8.25, right? That's super difficult. So the reason why the equity is becoming easier and easier to raise is, number one, people are getting hammered in the stock market. Between 2007 and 2009, the stock market dropped 22%. Last week, I did an equity raise that was fully subscribed in like 18 hours. So every time in my equity raises, I always talk about what's the year to date on the S&P 500. And on that day, it was 20% below. In what, we're in month 11 now. So over a 2-year period, the stock market fell during 07, 09. We had that same fall basically in 11 months. So people are trying to get out of paper equities. The second piece is people are trying to beat inflation. So the government says inflation is like 8.25%. That's all bullshit, because the way that they structure the CPI is every time something in the CPI gets too expensive, they substitute it. So they say, okay, steak, a New York strip is now too expensive. So now instead of using New York strip prices in the CPI calculation, we're going to use ground beef, because those people won't be buying New York strip anymore. So that's a really terrible way. And then the second thing is, in the CPI, they don't take housing and fuel costs or gasoline or heating fuel into account. So if you look at like shadowstats.com, which is, you can calculate CPI based on the 1990 calculation, based on the 1980 calculation. The 1980 calculation right now, we're at close to 16.5% inflation, right? So it's super high. So people are trying to find other ways to, at least preserve their cash, if not grow it still in this market. And then on top of that, self-storage has been one of the best producing assets in recessions over the last 5 recessions, right? So from 07 to 09, stock fell 22%. Self-storage fell like 3.8%. And that was a study done by the National Association of Real Estate Investment Trusts. So these are like big, slow moving corporations. I knew a lot of people like Scott Myers that made a ton of money during the 07 to 010 crisis, right? If you want to talk about something even closer to the memory, let's look at the pandemic. In the pandemic, there's a research firm called TREP, TREPP. They do research on commercial mortgage-backed securities. So of the 1,700 CMBS loans that were made to self-storage investors in the first 3 quarters of the pandemic, only 3 were over 30 days delinquent. That's a 0.17% delinquency rate.
Wow.
At that same time, multifamily was defaulting 1,800% higher, 18 times the default rate of storage. So a lot of my investors over the last 18 to 24 months are other real estate investors that are getting out of office building. Man, the office guys got really wrecked. Office buildings, medical, residential, multifamily, all of that. And then on the debt side, what we've been doing to kind of pivot is you're starting to see the resurgence of these participating lenders again. So participating lender, for your listeners out there, somebody where they're going to give you the debt, but they're going to give you the debt at a discount. So instead of giving me like 8.25, they're going to give me a 5% rate. But in addition to the 5% rate, they're going to go to a higher leverage point. Instead of say 65%, they'll go up to 90%. But then they want 35% of the cash flows and the proceeds from sales. So they're like debt and equity at the same time. But the key is that they don't take any of the tax benefits. So I keep 100% of the depreciation, which in storage with these cost segregation studies, I get insane bonus depreciation, right? I just did a deal that won that oversubscribed in 18 hours. For every dollar an investor put into my fund, they got 97 cents back in depreciation year one. So a lot of my investors are people where they're more now trying to preserve capital and trying to reduce their capital gains from all these insane cap rates. Everybody that's been selling over the last 2-3 years with these super tight cap rates, they now have all these crazy tax implications from that they need to offset. That's what we've been doing a lot.
So on a higher debt, right? So you're like way north of 6, and do you see is using a 5 to 7 year hold makes that easier to exit, to kind of offset that, hoping for rates to go down where you can refi and go with that, go that route?
Right. So the minimum on every one of our deals is it's a 5-year hold, right? But now, because of all the uncertainty that's going on, and because of, we're getting a little bit bigger, we have a little bit more clout, people know who we are. Now we have like insurance companies reaching out to us, and they're offering us 10-year perm debt. So 10-year, I just closed one in West Virginia. It's actually the largest U-Haul dealer in the entire state. You were just talking about U-Haul. That deal, I got a loan from a conglomerate of life insurance, smaller like boutique life insurance companies. It was a 10-year deal at like 5.37% interest, with a 10-year balloon. The only problem with that type of debt is that you lose a little bit of optionality, correct? Because the life insurance companies, when they make investments, they need to be able to count on that income coming in, because that's how they offset their liabilities from people dying and then having to pay out, right? So they have these things called yield maintenance or defeasance clauses, which I'm going to simplify it a little bit here, but basically what it means is like, you got a 10-year loan from us. That means you're paying us 10 years interest, regardless if you refi in month 5 or not. That's not exactly what it is, but if you're planning for worst case scenario, that's basically what it means, right? You're paying the whole 10 years interest, regardless if you use the 10 years or not. So it locks you in a little bit. You only want to use that type of debt on facilities where you don't have any capex that you got to spend, like major expansion projects or whatever. The cash flow is pretty good, and all you're really going to do is just mess with the numbers, right? You're going to raise the income, you're going to drop expenses. You're not going to add any additional units or whatever.
Yeah, they're securitizing that paper, right? In most cases.
That's right.
They got to break up the bond. It's crazy. The defeasance clause is crazy. Right. Yeah.
Then I have to go calculate the difference of them getting a bond and investing it versus what they would have gotten from me, and then I have to pay that difference. So that's too much math for me. I just say, hey, what's the full interest load? That's what worst case I have to pay, is that full interest load, right?
Yeah, I just did a deal like that. It was a 120 unit deal. I just got to make in multifamily, not storage. I'm still in a multifamily. I'm still crawling before
I get it.
Run.
No, that's all right.
I know you feel sorry for me. I hear your voice.
I invest in storage. I mean, I invest in multifamily. I just don't want to be the operator. I'd rather give you the money so you could suffer, and then I just get a paycheck. Right?
I got it. So
diversify.
It was set up like that where there was some defeasance costs, and I had to. It's the higher the rate went, the better it was for the seller. The lower the rate went, the worse it was for the seller. Right. So we wrapped up. I think the 10-year was somewhere just right about 4, like right before it started going crazy. It was like 3.76 actually it was. And I was like, let's lock this thing in and let's close. And it worked out pretty well for the seller. I was able to get like 600,000 discount because he gained where I lost, and I was able to say, hey man, I don't want this to be one of the situations where it's going to fall apart because the 10 years is out of control. It's like a roller coaster. This is what I need to close, and basically he took 600,000 off the deal and made it work.
He probably still saved more money than
for sure. Oh, for sure. When I saw the statement, I was sick. When I saw the closing statement, I said, God, I should have negotiated better. Oh my God. He walked away with the bag. I mean, a big heavy bag.
If it's a win-win, it's a win-win, right?
Sure.
You got a good deal,
I got a great deal. This is a smoking deal. I love it. But yeah, so we kind of talked about where we are in the marketplace and how interest rates are affecting everything. Like, what's your plan? Like, looking out, right? I know you don't have a crystal ball,
Right.
looking out to say, okay, I'm going to be in this storage thing. It's marry the unit, and what do they say? Date the rate and marry the storage unit. Usually date the
That's
property and
right.
marry the rate. So is that kind of what you're going through now? You just
Right.
really now let's talk about the size of these deals because you're talking about terms and stuff, but let's give the audience some color
Yeah.
on the acquisition price of these deals.
Right. So when I came on your podcast on episode 51, that was like January of 2020. So my average deal size at that time was like 1.1 to 1.8 million. Now my average deal size, because I'm doing these like class A regrade things, because again, I want my buyer not to be someone like me that's a savvy negotiator that only has a few dollars in his pocket. I want some publicly traded company, some REIT, where literally the REIT status means that they have to deploy 90% of their capital every year. They cannot hold more of that or else they lose their tax status, right? So I want somebody that has money burning a hole in their pocket. And they typically only like to buy these large assets that are new. So now my average deal cost, you're looking at 13 to 15 million a piece is what we're doing. This year alone, in the next 6 months, I'll probably be closing on 70, 75 million in storage alone. Or
That's
I'm sorry,
awesome.
70, 75 in debt.
That's
70,
awesome.
75 million
So
in debt.
so what do the terms look like? They financing 60%, 70%, whereas right now is around 60, 55% right now, right?
Right, right. So the answer everyone hates, it depends, right?
Yeah,
You
yeah,
know, the adult diapers out here. So
yeah.
here's what I'm going to tell you. So it depends on the type of debt you're getting, right? So with these ground up construction deals, you have to go to someone that's willing to lend on future value, not based off of cash flow, because it's just land. There's no cash flow, right? So you're already cutting out basically all the life insurance companies and CMBS because they lend on a debt yield basis. So now what I'm doing is I'm going local banks. Local banks are in the 75% LTV range, LTC, I'm sorry, loan to cost range. And they're quoting me in the, prime plus 1.5, prime plus 2 range.
Okay.
Now, if I want to go up in leverage, I have two other options. I can, number one, go to debt funds. These debt funds, they usually don't make money on the rate. It's a pass through, but they make money on the points. So they raise money from investors. They pass through the rate to the borrower, but then they make money on the points. So I just did a deal in Pennsylvania, in Wilkes-Barre, where they're giving us 84% loan to cost, but it's a 3+1+1. So it's a 3-year loan, point in, point out. And then every year I have 2-year extensions, 2 1-year extensions, and each one of those years costs another point. So I'm going to use all 5 years. So it's going to be 4.8% interest, right? So a little bit higher. And then if I want to go really high leverage, in case I don't, you got to realize my investors, they make 20, 22% internal rate of return. So any debt number below 20%, I'm still in the green if I can replace equity investors with debt, right? So instead of going, let's say an 84% loan, or let's just say a bank, a 75% loan from a bank at, call it 8, now 8%, I can go to a debt fund and say, go to 90%. They give one of these participating lenders, right? But they take 35% of the cash flow and 35% of the sale proceeds. So they're kind of like a pseudo equity investor. The same lender that I'm working with, they'll go up to 100% financing of this hard and soft costs. So they won't cover like interest reserve, operating reserve, developer fees, syndication fees. So I still need to raise a little capital for that piece. But they'll go up to 100%, but then they want 50% of the cash flow and they want 50% of the net proceeds. But I get to keep all the tax benefits. So those are what I'm kind of seeing right now in the debt side. Their coupon's 4.99%, which is good because they're making most of their money on the equity piece. And then the last piece now, which is starting to come back into vogue, our friend Eddie Speed, Mike Jake, they taught us about seller financing. So now we're doing a lot of seller financing talks where instead of me coming to a lender or to a seller and saying, hey, here's my price, here's your price, I say, listen, unless you're living under a rock, you see what's going on with the Fed, you see what's going on with interest rates. Like here's what I can pay you. And I don't give them a number. I say, I need to have a 1.25% debt coverage ratio based off of a 75% loan to cost. So whatever your NOI is, just do those calculations and assume a 8.25% interest rate and let me know if you can do that price. And most of the time after they figure out how to do all that math, they say, I can't do this price. I say, okay, well, what price do you need? And then they give me a price and say, okay, what if I'm able to do that price, but we get a little creative? And what if you collect the interest instead of a bank? And they say, okay, I'm interested. And then so we start negotiating seller finance. And I think these types of strategies are going to have to become more and more prevalent over the next couple of years. Because if you want to ask me about my super muddy crystal ball, what I'm seeing the Fed funds rate going up between 5 to 6%. We're at what, 4% right now, right?
Correct.
So 5 to 6%, and then they're going to hold it there for 2 years.
That's going to look
at
ugly.
least 2 years, right? So a
Get
lot of people
prepared.
that took short-term construction loans, that took short-term bridge loans, expecting them to refinance in a better environment, they're going to come up short, and there's going to be a lot of opportunity for people like us with cash to buy.
We're waiting.
You know,
it's not happening fast enough.
No. So I think rates will start coming down 2024, end of 2024, early 2025, but they're going to sit at 5 to 6% Fed rate
Be a
for
lot of
another 18 months. But this is the time to invest, right? So it's funny. They said the same thing between 2007, 2009. This is going to be the epic where everybody makes. This is where billionaires will be made. And I think there's even a greater opportunity now than there was in 07, 09.
I agree
to do
with
that same thing.
You're becoming a deal architect, my friend. You're dropping some jewels on the show. I really appreciate that. I hope the audience appreciate when I bring guests like you on who don't hold back and just share resources. You gave a contractor earlier that builds stuff from ground up and everything else. Is not holding back, this giving value. I really appreciate you coming on, man. Let's give the audience, if people want to reach out to you to do a deal with you, to invest alongside of you, where can they reach out to you and get some more information from?
Yeah, two easy ways to reach me. If your members remember my episode 51 recording. So there's the hard way and there's the easy way. The hard way is you can go to any one of my social medias and just type in The Storage Stud. I didn't come up with that name. That was my partner Steven, the marketing guru. So The Storage Stud, that's everything. That's TikTok, Instagram, Facebook, LinkedIn, whatever, all Twitter, all of them. The easier way is just to hit me up on my cell phone. Text messages is preferred, but you can call me too. Just realize you're East Coast, right? So I'm 2 hours east of East Coast right now. I'm in Brasilia time, down in Brazil. So my cell phone number is area code 630-408-8090. It's my real number. Shoot me a text message. I'll get back to you within 30 minutes. No problem.
Appreciate you coming on the show, man. It's another great episode of PFREI, a passion for real estate investments. Oh, man, this is really good, man. I really appreciate you coming on, man.
I appreciate you too.
And you guys can catch the show on all social medias, iTunes, and whatever they have podcasts at. Be sure to catch the show.